Hey everyone, welcome to the KE Report, another daily editorial on this Friday. Now with Joel Elconin, co-host of the PreMarket Prep Show. You can also check out the PreMarket Prep website, which I will link to in the show notes. Joel, let's start with broad averages. U.S. markets, boy oh boy, they have been choppy. The nice run up at the tail end of the year after the election, and then really since mid-December, it is up, down, really sideways, but all-time highs are being sold quite quickly. Rips are being sold, and dips are maybe tentatively being bought. Biggest news that keeps driving this choppiness continues to be tariff news and the lack of some tariffs being in place and some just announcements that they could come in place. It seems damn near impossible to trade around this sort of news because we don't know what's coming out of Trump tomorrow, let alone in the next couple minutes. So, Joel, what's your takeaway from these markets? Again, choppy, but at least they're holding still somewhat near all-time highs when you look at something like the S&P.
Oh man, Corey, you just stop. Well, first of all, thanks for having me this afternoon. You made so many excellent points in that introduction. I guess you could look at it two ways. There's the Trump pump and the Trump dump. And it just seems like how you're positioned. If you're a shorter term trader, when those tweets or those messages come out, makes it a very, very difficult short term trading environment. You are right in the fact that the index like the S&P is up near all-time highs, but that's just because of the diversification of the index. What we've seen in this market really over the last several years is if they're selling something, they're buying something else. And just to quickly explain that, you have just using the triple Qs, you have non tech components of the triple Qs, like your Pepsis and your Comcast. And I think even like something like a Home Depot may be in there. So on those days when they are hitting those big stocks, really to keep the ETF in equilibrium and not have a complete fallout in the market, they're buying those stocks. So what you're seeing is just this rotation in the market. Well, you do get big down days, but it's just not across the board. And something like the S&P, I mean, if you look at what the top components in the S&P have done, and you look at the Mag 7, you look at majority of the reports, you would think the market got absolutely destroyed the last 2 weeks. But that's not the case. That is not the case at all. It's the rotation keeping this market afloat.
Well, and that's a trend that we continue to see, right? Where would the money go elsewhere? Maybe that's a question we should be asking is that for all these bears out there that say that the markets are overvalued and they need to drop, I understand individual stocks can be overvalued, but what would be the impetus and where would money go if it were to just broadly leave these markets?
I have absolutely no idea. I don't know. I mean, it's just, I think what one thing that kind of adds to the picture is you have a very, what I perceive as a stable interest rate environment, right? So, yeah, you could get, your 4 or 5% on your money, but the market has become so focused short term that they go into the momentum stocks, or if they don't go into the meta maybe there's some stock that's 19 standard deviations off its current price and they're going in for a shorter term trade. So, the long term money will, and the algorithms will rotate. But I mean, gold's been a nice alternative. We could talk about that a little bit later. Bitcoin seemed to cool off a little bit. I think where some of the money is going here, just based on the recent price action, is China, believe it or not, with the tariffs and everything that's going on. But just 4 or 5% is boring, right? And so people are going to move the money around. There's a couple alternatives for you, but it's just the volatility right now, 5%, 4%. It's not too bad when like a stock that you could be owned could be sitting up at a recent high of the move, and then it loses 25%. I guess it's all about your risk for appetite if you're not going to go into the high flyers or the Mag 7.
Well, we have seen some fishing line sell offs, and yes, we will get into gold, which has been continuously strong. But look at that 5% safe money bet that you could make. It's also been around for a little while too, right? So it's not like it's sucking in a whole new breed of people because we just got there. So Joel, it's all about leadership. The markets, when they move higher, it seems like a concentration of capital in the biggest names, the Mag 7 names. But after some of these earnings, boy, oh boy, the Mag 7, they've taken it on the chin, a number of them. But as you said, this money's just rotating. So what's your takeaway from some of these recent earnings out of Alphabet, out of Apple, out of some of the other Mag 7 names that broadly have gotten hit?
Corey, if I threw you in a bubble 2 weeks ago and I gave you some of the price action and something like Apple or Google or even Microsoft longer term, Microsoft peaked a while ago, or Tesla, you would think that the market's down 10, 12, 15% over that time period. But it's not, because the market is migrating to a lot of the laggards from last year. Look at your healthcare sector, right? Your energy sector is doing okay. Yeah, I mean, it's stalled. I mean, the Mag 7 has stalled. There's no doubt about it. Now, you're going to get people, they're going to argue, well, that's great for the market. You're going to get more diversification. It's going to be more of a broad based rally. And then you're going to get another contingency that says, oh, if these stocks are going, it's only a matter of time before the rest of the market falls. So, your small caps, which, really are, they need lower interest rates, that doesn't seem to be happening. So, it's also like the haves and the have nots. If you're a good company, you come out and you beat, they love you. But then if you go too far, you get sold off. If you're a company in the gutter, like Elf Beauty or Skyworks, you come out and disappoint, they absolutely punish you. So I guess the best way to call it, this is a very unforgiving market.
Is there a rotation then out of the major leaders, which I guess we have seen, as you said, that a lot of these stocks are down fairly significantly, into maybe the second tier of leadership, the not mega cap, but the damn near mega cap stocks? Again, that filtering down of money, just one rung down the food chain.
Yeah, I mean, you're talking about the big caps, which, I can honestly tell you I don't follow very closely. But, there's hot stock, man. What about quantum computing? Come on, man. You got to get into quantum computing, right? That's going to be the next big thing. So, the mid caps, yeah. I mean, I'm trying to look at some of the mid cap ETFs here. So they could be. I really could say I don't follow them as closely as I do. So for once, I'll be a little bit tepid on my comments.
So, Joel, is this still a momentum chasing market then, where if you have some breakouts, if you do have an uptrend, you gotta ride it still?
This is the way I've always approached breakouts. If you want to be a breakout trader, that's fine. It's just that you use it, whether you're a shorter term or swing term trader, you play in a breakout, you better play it close to your belt. And what I'm saying like that is, like, you get a breakout. I'll just use a stock that I've been wrong on, like Palantir, right? I mean, this thing is loved. If you're loved and if you're not, okay? Palantir broke out. They had a blockbuster earnings report. That thing put a major gap in here between 82 and 100, right? And then it just kind of waffled for a day or two. If you're playing that kind of breakout, well, congratulations to you. But I would just say, hey, if this takes out the post earnings low at 99.32, I'm out. I don't care if it just ticks down there. But if you were taking that strategy on February, let's say the earnings day was the 4th. If you took that strategy on the 4th, of course, this is hindsight capital, and then you see it undercut the low from the earnings day, 10051, goes to 99.32, comes back up through that low, and you take along at 10051 with a stop at, reaction low, you're up $15, Corey. I mean, so that's the way you play it. As far as like trying to buy the dips on this, I mean, if you're short on something, like, did you see what happened to Skyworks yesterday? I mean, just a huge down move, gets back to levels below COVID lows, back to the 2019 lows, then you can play it for the standard deviation move. But what happens is something like Skyworks is that, large hedge funds or large traders or trading groups, proprietary groups that are not stuck in Skyworks build a big position like, oh yeah, don't frown, average down, we'll buy this thing all the way down. What was the low? I don't think it took out the pre-market low. Yeah, we'll buy a 500,000 shares between 60 and 62. We're not looking for this to fill the gap. We're not looking for this to go back to $85. We're just looking, maybe 70 is your target, maybe 72 is your target. Don't so But all the people, all the bag holders that are looking for that gap fill, man, oh man, they're fighting an uphill battle.
So, Joel, just to take away from this earnings season so far, and it's still relatively early on, but to me, it seems like there's a bit of a change in tenor here where holding into earnings this year is tough. Usually, I feel like we have more surprises to the upside and stocks are performing better. I don't have exact data around this, but this quarter's earnings season, boy, oh boy, it seems more negative than positive so far.
Right now, and this is not investment advice, it just seems like be short everything, because it seems like you pop, okay, on a good report like Apple. Did you see that mind-boggling price action in Apple? A week ago Friday hits 247, comes back down to 228 this week. They hit you. And if you miss, you get punished. And, you get punished on the overnight position. Perhaps, day trading it or going a swing trade off the bounce is a a big difference too. There's always exceptions to the rule, but right now, you know, fading and if a weak stock has a gap up, holy mackerel. They're all over that thing. So right now, it's been a treacherous earnings season, and with the other factors going on in the market, I expect that to continue.
Yeah, tough start to the year in terms of earnings here for these Q4 earnings. Let's talk precious metals then. Gold continues to perform very well. It seems like $3,000 an ounce is right around the corner. I know that's not really a technical level, more of probably just a psychological level, but this strength in gold continues. Joel, is that also telling you that, look, investors are simply a bit more defensive?
Yeah, I think there's been a little bit of a rotation. Like, there's rotation in stocks. There's been a rotation a little bit out of Bitcoin, I think, into the precious metals. For full disclosure, for all you people that have been listening to me rant for years about my gold position, I'm out of it. And it's not for really any fundamental or technical reason. I've done just some re-asset allocations, changing some portfolios around, and I decided just to flatten out this one account, start flat, dumb, and happy. And will I regret it? Probably. But this was something that I bought back during COVID. So I'm not going to argue with the return. But right now, the thing about the gold and the GLT, that's just like the prettiest rally. And then one day you're going to, you can't guarantee anything, but it's going to be down $100, $150, and then it will get killed a few more days. And then it will, the way it's trading so far above its 50-day average, if you have a target, I think that I like to stress with people too. This was not a target for me. This was a long-term investment. If you're in something for a short-term trade or long-term trade, and you hit a target, a long-term objective, then take it. Because if you don't, the market's going to punish you.
So, Joel, are you going to re-enter this position even after, let's say, $150 pullback, which really in the big picture is not that much considering gold is almost at 2,900 now? Is that what would bring you back into the...
I don't know what would. I don't know. I don't know. I was in it for a long time. I'm out of it for a long time. I think if I did get back into it, it would be more not as a longer term hold, but more of a shorter term swing trade or intraday trade. So right now, If I want to put on my long-term investor hat, this is the GLD. This the 50-day average is 248.21. It's traded 264. Don't have a buy point in it.
Well, Joel, what are we looking forward to next week then? What could move markets outside,
Ho,
of
ho,
course,
ho.
your president tweeting?
Yeah, picking on you guys. I mean, I'm so glad they're letting me do the show. I did get a call from the White House today, and I'm not sure, if I'm going to be banned from doing this show anymore. But you know what you have next week, Corey? Inflation data. That's what you have.
What about
Yeah.
inflation expectations? Those are skyrocketing right now. How do
Yeah,
those
I
play
mean,
into this mix?
yeah, just just to end my segment here. If y'all get a chance to listen to my show today at 9 a.m., I had the former chief economist of the Chicago Mercantile Exchange, and Blue Putnam is his name. And he came on the show, and what's the dirty word that no economists like, or not money managers don't like to hear about the markets? What's a really dirty word?
Recession?
You got it. You got it. And he's not like guarantee a recession. Like we've had, what, 47 recessions predicted in the last 80 years, and we've only had seven. But he made a very strong argument for a potential of a recession. And the number one is a trade war and tariffs. I think everybody, and I don't want to sound political here, but Trump and his administration are the only ones that don't know the tariffs are inflationary, right? And they're going to have a negative impact on the economy. Also, I don't know if you know about this, but there's been a lot of layoffs or willful resigns from government jobs, right? That's labor market disruption. So you have a trade war, which could induce higher inflation. You have labor market disruption, and then you got budget spending cuts. I don't know. I'm no economist, but couldn't that signal lower GDP in the future and a potential recession, maybe in the second half of this year? So that's just, those are, I didn't come up with this thesis, but I tell you, I printed it up and I'm taking a good hard look at it because I think the people always, when they're not talking about something, it's best to bring it to their attention.
Yeah, so true. Let's see where this all plays out. It's still so early on in Trump's presidency, but clearly the markets are jittery, to say the least. And all the surveys we're seeing have people expecting higher inflation and just simply weaker confidence. We'll see how that filters through. But hey, Joel, always great chatting with you and always very entertaining. As long as your president will let you keep coming on the show, we'll keep having you on. So, Joel, thanks for your time. Hope you have a great weekend.
Okay, thank you, Corey.